Well, let me toss it across to Surabhi, who's at the JPMorgan conference, and she's sitting down with Saurabh Kumar, Senior Analyst, India Banking and Financials Research at JPMorgan. Surabhi, over to you.
Prashant, thank you so much for that. Yes, I'm here with Saurabh Kumar, who tracks a sector that seems to be finally stirring back to life. It's a sector that's been underperforming for a while, and the whole question is that when foreigners start coming back to this market, will they keep loving Indian banks and the Indian BFSI space? So Saurabh is here with us. Saurabh, great to be talking to you in person. Thank you so much for making the time for us. And, I really want to start with that first question. So let's get the elephant out of the room. This whole debate around how banks are struggling to mobilize deposits and how that's going to take a toll on the business model itself, because everyone's rushing to put that money in the equity markets. Is the fight for deposit real? Is the struggle real? And if yes, can it really be detrimental to the profitability of banks?
Okay, so I think, parking money into equity markets or property is liquidity neutral for the system. It's just money transforming from retail to maybe wholesale. So I think the main issue is that our nominal GDP is compounding at 10%, so deposit growth at 12%, credit growth is higher, and that's a fundamental mismatch. And eventually, I think you will see credit growth converge towards deposit growth, unless obviously nominal GDP picks up. I think in terms of fight for deposits, what you will see is wholesale deposit rates are falling down, but retail deposit rates have largely been maintained. The real issue in the system is around CASA, because in this environment of asset reflation, nobody wants to park money at 2-3% on savings rates. And that is where you're seeing incremental deterioration in the funding profile. Having said that, if you look at the cost of funds movement across major banks, it's been, the rate of increase has largely moderated down. From here on, it is just CASA mix or whatever the rates do.
So that brings me to the other sort of theory and the premise that you put out in a recent note, right? Because when we're talking about bank margins, the immediate sort of conclusion that most people jump to is that it's contingent on rates.
Yeah.
Lower rates should mean better margins, and higher rates could perhaps increase the cost of funding, or maybe vice versa, depending on your loan mix, depending on your borrowing mix as well. But you're saying that's not the case. It's not really rates that will determine NIMs, but perhaps the CASA mix. So could you explain this further?
Yeah, so I think the thesis is essentially if rates come down, margins come down, rates go up, margins go up. If you basically see the movement of rates over last, let's say, 2 odd years with a 250 basis point rate hike, most of the cost of funds has been equal to the yield on assets increase across major banks. So over a 18 to 24 month period, it's a pass-through structure that most banks operate in India. You do get quarterly volatility in terms of margins coming down, but they do revert back. Over a period of time, what dictates the margin is the loan mix, which is the share of unsecured loans rising, if at all. And the other is essentially your CASA funding. And as that funding profile obviously worsens, your margins come down. So rates is a two-quarter phenomena. I think what matters over a cycle and what I think matters from a valuation or stock price perspective is your eventual target NIMs or target profitability, ROAs.
Okay, so that's the theory. Now let's apply that to the current environment where CASA growth, like we discussed, is getting crimped. The Reserve Bank has obviously been sort of raising the red flag on unsecured lending, so your yield perhaps is getting more challenged. And we are in an environment where the Reserve Bank is expected to follow most other central banks and start easing at some point. So just take us through what you expect on NIMs here and whether you indeed expect the RBI to start easing by the end of the year.
So for JPMorgan, our expectation is for a rate cut cycle to start December. Cumulative 100 basis points will be what I think our economists forecast today. Broadly, that should lead to a 10 to 15 basis point degradation in NIMs across banks.
That 10 to 15 point degradation in NIMs?
15 basis points, yeah.
15 basis points
degradation in NIMs.
Having said that, over what period you'd expect, over how many months?
So it depends on the trajectory of the rate hike, but it should happen over a 3-quarter period, I think. But more importantly, I think what will also depend is how quickly they cut rate. Is it 25 basis points every quarter? Is it 50 basis points? So I think that will be more important. I think the main issue for banks is, yes, NIMs are coming down. For private banks, credit costs are also going up and growth is tapering down. All of this should mean that your EPS should be at some marginal risk of degradation till October of next year. And I think that is where I think risk of downgrades remains. Having said that, there is obviously flex many banks have in terms of their operating costs on their credit, which I think can essentially mean that there is some flex to operate at around target ROAs. Some of these numbers are also captured in the street estimates. So I think the key here is essentially who can grow faster And this is where we basically are betting on banks where loan growth is actually faster than the system and who have the funding flex and the capital flex to basically deliver that.
Okay, and so talking about loan growth itself, considering that, like we discussed, unsecured continues to be very tightly monitored and watched, and we've seen the risk weights go up there as well. What will drive loan growth? And there's this whole talk about the capex cycle picking up. I don't know if that can really incrementally drive it. So where will the book grow, and what kind of lenders would you then watch?
What we're seeing in the system, and Reserve Bank puts out this data, I think if you look at the growth is now being driven from mortgages. So mortgage growth has picked up. The large industry growth has actually picked up from about 3% to 9% if I recall. So yes, you're seeing the headline growth rate down from 15% to 14%, but you're seeing a shift in mix away from unsecured loans toward more secured retail, towards corporate sector, and that is what our overarching view is, that effectively you are in a cycle where what we call it capex over consumption, that capex linked plays are actually going to do better versus consumption linked plays.
Okay, Saurabh, hang on. Our colleagues in the studio also have some questions for you. Prashant, over to you.
Saurabh, hi. Hi, good morning. Good to see you there at the conference. Since we're talking about specific segments, I just wanted to ask you three segments. One is microfinance, right? I mean, there's a lot of talk that we're going through a down phase, a down cycle. I just wanted to understand where we are at. Are we we're just getting into it? Are we midway through? And when do we get out of it, the microfinance bit? Second is housing finance, which seems to be kind of everyone's favorite. Strong momentum and very low NPLs historically as well. What's your view there? And I think you've liked CV financiers about a month and a half ago when we spoke. So just wanted a quick sense on these three segments.
Okay, so on microfinance, I think we are clearly mid-cycle. I think there is more pain to come probably this quarter. Having said that, even if credit costs peak out, I think growth could remain challenged for some time because there has been clear over-leveraging for customers at that segment, and that will take some time to wash out in the system. On the unsecured loans more broadly, I think you should see peaking out of credit costs in Q2, starting to decline Q3, but I think again, growth will remain challenged for the broader unsecured piece, I think, going into next year. On housing finance, I think we remain constructive. Basically, what you're seeing here is as property prices appreciate, it does two things. One is collateral values rise, which means that your credit costs actually come down. Obviously, with the rising property price, nobody wants to default on their home loan or even a LAP loan. And the second is obviously for the same amount of loan, you're disbursing higher value. So housing finance from a cyclical perspective, given the underlying sector, looks much, much better placed from a growth and from a credit cost perspective. So that be the view. On CV financiers, we think we are indirect plays on the capex story, which we like more broadly, and obviously they also benefit from being a fixed rate book in an environment where rates fall. You could potentially get margin expansion. So CV, you get again, we think growth will be better than what markets think, and I think more importantly, there is potential of margin improvement and credit cost remaining benign. So CV, to our mind, CV financiers, especially in the NBFC space, do look very interesting to us.
Yeah, Saurabh, you are also the real estate analyst, right? You track that space as well, and that is an important part of the entire, such an important part of the entire mix. It supports so much else. That cycle remains as solid as ever. There was a little bit of a slowdown maybe in the sales in last quarter, but just a quick overall view there.
Yeah, so we think we are in the fourth year of a typical 7 to 8 year upturn. We are probably mid-cycle. Inventory levels continue to remain low in the market. Prices continue to move up. And eventually, obviously, after 4 or 5 years, we'll probably see a downturn. But I think given the conditions today in the market on inventory levels, given the fact that prices are appreciating, which basically gets some amount of pent-up demand also to come in, some amount of investment demand to also come in, we think the cycle will remain supportive till you see supply levels go up substantially. I think the cycle will basically break up on supply or debt. We don't see that risk today.
Sort of finally, to sum it up, and I'm going to come back to financials. So banks may see a slight crimping of margins, and then we need to see if they can keep sustaining strong loan growth. Some argue that maybe the best of the asset quality is also behind us, and the curve goes down from here. In this environment, Are you, as an investor, are you better off for looking at banks as an investment, or should you go back to, let's say, capital market plays or insurance or asset managers, because some of these have been, or even wealth managers, because some of these stocks have been fantastic wealth creators already?
So yeah, I mean, they tie it to this broader thesis of saver to investor, that the money is moving from savings accounts to some of these plays. But I think from a large cap bank perspective, yes, some of this is also priced in. The valuations are pretty reasonable for the growth on offer. And I think if you are a value investor, or valuations do dictate some amount of your investment outlook, then large cap private banks do look good. They are still taking deposit market share. They're still taking credit market share. I think from a capital market businesses, they do look interesting from a growth perspective, but I think valuations are quite heady at about 35 to 45 PE at this point of time. And there is obviously this risk of some, if market were to tail off, I think the operating leverage could play on the negative side. Okay, so some of the large private banks remain your preferred bet. Yes. Got that, Saurabh. Thank you very much. Very insightful conversation. Thank you for joining us on the show today. Thank you, Surbhi. Thank you for having us. Thank you. Well, with that, it's back to the studios.
Thanks for that, Surbhi. Well,